Crypto investing can be risky, but avoiding these 10 common mistakes will give you an edge. Are you making these errors? Let's find out. Welcome to Crypto Finance. Number 1. FOMO Investing. Fear of missing out is a dangerous emotional response many crypto investors experience when they see others profiting from a coin's sudden surge. The fear of being left behind often leads to rushed investments, usually at the peak of a price rally, and buying high can lead to selling low when the market corrects. To avoid FOMO investing, develop a clear investment plan based on research and long-term goals. Stick to your strategy and avoid impulsive decisions fueled by emotion. It's crucial to remain disciplined and patient in the market, as volatility is part of crypto's nature. Remember, opportunities will always arise. Sticking to your plan ensures you're prepared to capitalize on them without being driven by fear. By staying focused and avoiding short-term distractions, you'll be in a much better position to build a stable, profitable crypto portfolio over time. Number 2. Lack of research. A common mistake made by crypto investors is jumping into investments without conducting thorough research. This can lead to unnecessary losses as many cryptocurrencies are speculative and prone to volatility. It's essential to understand the project's technology, market use case, the team behind it, and its long-term viability. Research provides clarity on whether a cryptocurrency is likely to succeed or if it's simply riding on hype. It's also important to track the project's progress, news, and regulatory environment. By taking the time to research, you'll minimize the risk of investing in low-quality coins and avoid the disappointment of watching your portfolio decline. A well-researched investment strategy will allow you to make informed, confident decisions. In the world of crypto, knowledge truly is power, and staying informed is key to long-term success in this ever-evolving market. Number 3. Ignoring security practices. Ignoring basic security practices in the crypto space is one of the most critical mistakes investors can make. With the rise of digital assets comes an increased risk of theft, hacking, and fraud. Failing to use strong passwords, neglecting two-factor authentication, or storing large amounts of crypto on exchanges exposes your investments to potential breaches. To safeguard your assets, use hardware wallets for long-term storage and always enable two-factor authentication for added protection. Never share your private keys and ensure that any platform you use has strong security measures in place. Staying vigilant against phishing attacks and scam websites is also crucial. By prioritizing security, you greatly reduce the likelihood of losing your crypto assets. As the digital world continues to evolve, it's important to stay informed about the latest security practices to ensure your investments remain safe. Number 4. Overtrading. Overtrading is a common mistake among crypto investors, particularly when markets experience rapid price changes. Many investors make the mistake of buying and selling too frequently, hoping to capitalize on short-term price movements. While this might seem like a way to maximize profits, it often leads to higher transaction fees and missed opportunities. Overtrading can also increase the emotional strain on an investor as they try to outguess the market. To avoid overtrading, establish a clear long-term investment strategy and stick to it. Focus on assets with strong fundamentals and avoid reacting to every market fluctuation. It's important to be patient and let your investments grow over time. Instead of trying to time the market, invest in projects that align with your goals and risk tolerance. By trading less frequently, you allow your investments to flourish and reduce the stress that comes with constant buying and selling. Number 5. Chasing hype coins. Chasing hype coins is a risky move that many crypto investors make, often based on excitement rather than research. Hype-driven investments are typically associated with coins that experience rapid price surges, often with no underlying value or real use case. While it's tempting to jump on these trends, the reality is that these coins can crash just as quickly as they rise, leading to significant losses. Instead of chasing after every new, hyped-up token, it's better to focus on cryptocurrencies with established use cases, strong development teams, and long-term growth potential. Conduct thorough research before making any investment decision, and avoid getting swept up in the frenzy. Real success in crypto comes from strategic investments in projects that solve actual problems and provide value. By focusing on solid, well-researched projects, you'll be in a better position for sustainable growth in the market. Number 6. Poor portfolio diversification. One of the biggest mistakes crypto investors make is putting all their funds into a single coin or asset. While it may seem like a smart idea when a coin is performing well, it increases the risk if that particular asset drops in value. Crypto markets are volatile, and individual coins can experience significant fluctuations. To mitigate this risk, diversify your portfolio across different types of digital assets, including established coins like Bitcoin and Ethereum, as well as promising altcoins. This helps protect your investments from market swings and provides more opportunities for growth. A well-diversified portfolio balances the risks and potential rewards, making it easier to weather market downturns. Regularly review and adjust your portfolio based on market trends and new information. Diversification is key to long-term success in the crypto market, ensuring your investments are spread across various projects with strong growth potential. Number 7. No exit strategy. Having no exit strategy is a critical mistake that can cause crypto investors to lose substantial amounts of money. Without a clear plan for when to sell or take profits, investors often hold onto assets too long, hoping for higher returns. This can lead to emotional decision-making, causing you to miss opportunities or sell at a loss. A well-defined exit strategy involves setting clear goals for profit-taking, as well as establishing limits for losses. This allows you to make rational, objective decisions rather than being swayed by emotions or market fluctuations. Regularly reassess your portfolio and adjust your strategy based on changing market conditions. Having an exit plan ensures that you protect your gains and minimize losses, giving you the confidence to make decisions that align with your financial goals. It's about knowing when to walk away and securing your profits. Number 8. Falling for scams. The crypto world has unfortunately attracted its fair share of scams. Many investors, particularly newcomers, fall for fraudulent schemes promising unrealistic returns. Scammers use social media, fake websites, and even fake ICOs to lure unsuspecting investors. These scams often lead to stolen funds and irreversible losses. To protect yourself, always conduct thorough research on any project you're considering. Avoid unsolicited offers and never share your private keys or personal information with anyone. Stick to well-known, established exchanges and wallets and be cautious of too good to be true opportunities. If something feels off, trust your instincts and walk away. By staying vigilant and informed, you can avoid common scams and safeguard your investments. Always remember, in the world of crypto, if it sounds too good to be true, it probably is. Number 9. Using excessive leverage. Using excessive leverage in crypto trading can amplify both potential gains and losses, but it is a high-risk strategy that many traders use. When investors use leverage, they borrow funds to increase the size of their positions, hoping to make larger profits. However, if the market moves against them, the losses can be devastating and even lead to liquidation of their positions. To avoid this, it's crucial to use leverage sparingly and only when you have a solid understanding of the risks involved. Make sure that any leverage trades are in line with your risk tolerance and investment strategy. Additionally, ensure that your portfolio is well balanced and that you're not overexposed to any single asset. By keeping leverage at a manageable level, you can trade with confidence while minimizing the risks associated with large swings in the market. Number 10. Emotional decision-making. Emotional decision-making can be one of the biggest obstacles to success in crypto investing. Markets can be volatile, and it's easy to let emotions like fear, greed, and excitement drive your decisions. This often leads to making impulsive choices, such as panic selling during a downturn or buying based on hype. To avoid emotional decisions, stick to a well-defined investment strategy and set clear goals. Focus on long-term trends and avoid reacting to short-term price fluctuations. When you feel emotions taking over, take a step back. breathe, and reassess your position. Being patient and disciplined is essential in the crypto market. Don't let fear or excitement cloud your judgment. By managing your emotions and staying focused on your plan, you'll be better positioned for long-term success in this fast-moving market. Now that you're aware of the biggest pitfalls, you can invest smarter. Drop your thoughts in the comments, like the video, and subscribe for more expert investment advice. Share with friends who could avoid these mistakes too.